Welcome back to Real Estate Economics weekly webinar series. This week we're addressing the Denver Aurora MSA. This is part 2 of 2. This particular graphic shows housing demand and supply. As we talked about in section 1, the blue line here is the supply of housing. We mentioned that supply grows very slowly in almost all market areas. As everyone in the industry knows, it's quite difficult to acquire land, formulate product, get a construction loan, go through the entitlement process, and get those homes up and sold. So supply is fairly constant in almost all market areas that we deal with. By comparison, the demand for housing is again closely linked to employment, which does oscillate considerably. When periods of economic expansion come along, employment grows very quickly, and the demand quickly outstrips the supply. Then the market changes and the reverse happens, and all of a sudden, again, there are too many homes. The supply of homes is too great for the employment base. This shows that numerically, we can see that in the early 90s, this market was overbuilt. We had economic difficulties. We moved into the dot-com era and we became quickly underbuilt. The employment grew quickly and supply couldn't respond fast enough. Then we moved through the subprime era, where you can see this market was fairly controlled. The oscillations are quite small. The market was slightly overbuilt, maybe 40,000 units, but by comparison that's not that significant. Then we hit the current financial market disruption, lost a lot of jobs, and became significantly overbuilt that we're still paying back. Now by 2013, 2014, we'll be back towards equilibrium and gradually move into a situation where we're slightly underbuilt. It may be more difficult to rebuild our production capacity for homes than it is to rebuild our employment capacity. Here's housing valuation. Now, historically, these have been well connected because you had to qualify for a loan using, true income and all the known expenses of owning a home, the homeowners and the taxes and the insurance, that sort of thing. But then we got into, in the early 2000s here, we show the effects of the dot-com boom. People suddenly made a lot more money. Stock options became popular. People were getting stock grants and that sort of thing. So suddenly the supportable prices rose quicker than incomes because a lot of that income is wasn't really anticipated and didn't really present itself, or didn't get into the pockets of the people who had earned it until the very end of the year, and it was above and beyond their W-2 income, if you will. As you come out to about January 2009, you can see the sudden divergence where the green supportable median home price spikes. Now, what that's attributable to is when the government entered the mortgage market and rates went from 6 down to 5, suddenly the household income in the Denver Aurora area would support a much more expensive home. So the supportable median home price goes up. At the same time, we lost jobs, so the prices were coming down. But you can see over the forecast period, actually beginning in 2009 and throughout the forecast period, the supportable median home price in the green line isn't increasing. It's actually declining. Now that's attributable to higher interest rates. Incomes are growing slowly, disposable incomes might be stagnant, and rates are increasing, so the supportable home price is coming down. At the same time, the undervaluation that we talked about extensively in the first part of this webinar is gradually recognized, and people begin to realize once they have a job that houses are cheap and they can get a good deal, and those two lines will ultimately come together in equilibrium and then actually reverse. You can see that again in this particular graphic. The over and under valuation was fairly small from 1990 to about year 2000. Then with the stock options, the market became overvalued. People were stretching to buy bigger and bigger homes and capitalize on that wealth. There was quite a bit of academic data that most people spent the money they got out of their stock options, and it didn't take long. 6 or 12 months, it was burning a hole in their pocket, and it quickly outlet itself to a variety of consumer good categories. Now the market's become undervalued, and remains undervalued till 2013 or 2014, when gradually these forces start to restore discipline to the market and bring these factors back into sync. Here's median home prices for this particular market area. As you can see, for 2010 we're at about 223, 325. That's an annual number. That brings us back to about the levels we last saw between 2001 or 2002, smack dab in the middle of the run-up that went with the dot-com period. It's going to take us a couple of years to achieve that high watermark again. It looks like 2014, sometime during the period of 2014, we'll recapture that high watermark last achieved in 2005. Now here's the annual change in median home prices. You can see in the 90s and early 2000s this area had an impressive appreciation rate. Went a little bit soft by 2004. Now we've given back about 15 or 16%. This is year over year now, not accumulated. Going forward for the next few years, the appreciation, or the price improvement I like to call it instead of appreciation. Appreciation brings a little different concept in my mind. But the price improvement is really going to be the result of recognition of the undervaluation, as opposed to some improvement in local and regional economics that drives true appreciation. I mentioned earlier one of the products here that we provide at Real Estate Economics is our Opportunity Risk Report. And this takes a fairly detailed analysis of all kinds of factors that affect housing in this particular market area. We've talked about housing demand. You can see that on the far left side of the screen. That's, again, is manifest by employment, tends to move, is very well correlated to employment up and down. You can see 2008 was the recent peak, and now we've lost quite a bit of housing demand. We talked just briefly, or just moments ago, about housing supply, how housing supply grows steadily, doesn't oscillate much, but won't grow very fast in periods during any periods. It's just very difficult to add to supply quite quickly, and so that tends to move very slowly. Consequently, it's the employment that oscillates and the supply that remains constant. So you can see the periods of market is overbuilt or underbuilt. Those numbers are fairly large. You're 2 or 3% overbuilt, 2 or 3% underbuilt in 2004 and 5. Now in 2009 and 10, we're 4 and 5% overbuilt, again as a function of our loss of jobs. You can see the median home price. Now just a few moments ago we talked about our equilibrium home price. What is the price that this market can afford based on the median household income and current 30-year mortgage rates? As you can see, household income is relatively steady. It's increasing slowly. We are concerned that that number will not really reflect take-home pay or disposable income, if you will, because of higher taxes and taxes on employer-provided health care benefits. So people will actually have a little less money from 2011 forward than the figures before 2011 reflect. In either way, in either event, interest rates are going up, and that's going to put a little bit of a lid on price appreciation here. So gradually the employment picture will improve, income will be steady, and the magnitude of this undervaluation, this severe undervaluation that we have in the market today, will rectify itself. If you look at the far right-hand side of the screen, in the 2010 data, we've got this market at being about 20% undervalued as we sit here today. Gradually that undervaluation decreases to 18% in 2011, then 12%, then 5%, and the market reaches equilibrium again. But over that time period, you just don't see any improvement really in the equilibrium home price. So what's the net result of what's been taking place in this market? Obviously, we know the state and national economies have suffered huge job losses. In our view, many of those job losses are understated, and they are masked to some extent by decreases in labor force participation. If the normal percentages of people were in the labor force, the job losses would look much more severe. Those people, if they can be re-employed later, they will re-enter the job market at some point down the road, and that will add people to the calculations, and that will produce a very slow recovery. We're already expecting a slow recovery, but that will even prolong the slow recovery to a greater extent and produce really glacial improvements in unemployment over time. Housing construction is at an all-time low. We know that there are fewer opportunities. If you think how the market coverage distributes, during a very vibrant period in the market, you can sell low-end homes, medium-end homes, move-up homes, executive homes, semi-custom, all the way up the food chain. Those opportunities aren't here today. There's opportunities for people who've never owned a home, traditional entry-level buyers, but many people are settled to a home they either are underwater on or certainly can't extract equity from to do a move-up purchase. And so some of the market, the upper end, the medium, the executive, the discretionary, semi-custom, there are very few market opportunities up there. So really the spectrum of demand has contracted quite a bit through this housing market disruption. Affordability is at an all-time high as severe overcorrection is well established. You can see this in almost every market area. Experienced rental investors are going through the inventory and picking off the best homes, those with the best employment proximity, those in the best school districts, and a lot of that inventory is outletting to the rental market. It will come back to the for-sale market over time, but not quite yet. Give it a couple of years when appreciation starts to exist again in the market. Those rental investors will again return that inventory to the market. Distressed housing shadow inventory remains very high but is trending downward. We've seen huge improvements, huge increases in the number of short sales that are taking place in almost every market that we're active in. So lenders are preferring to allow short sales as opposed to making an adversarial foreclosure. Short sale proceeds have proven to be much higher than foreclosure proceeds, so we don't see any end in this. If anything, it's quicker and easier for the lenders to dispose of their inventory this way. We also see increases in sales of distressed loan pools and bulk purchases, as we talked about a little bit earlier. Distressed inventory is uncompetitive for many prospective owner-occupants. Now, we've talked about this a little bit. People do not want to buy a foreclosure in many cases. They don't want to buy a short sale. We've had many stories of people waiting 12 months for a lender to approve a short sale. Think of if you're a new home buyer and you're going into an existing market. You don't know who in that neighborhood is at their down to their last dollar and is going to be flushed out in the next 6 or 12 months, and take the values in your new neighborhood down another 3% or 2% or 5%. It's much more appealing to go into a new neighborhood where everybody's been qualified, where you can create those relationships that last years in some cases, and you don't have to worry about half your neighbors hitting the wall in the next few months. Now, the market will pay a premium for that, and so long as the premium is not overstated for that new home, demand is going to flow there and away from the distressed inventory. Marginal price improvements are observed in many, many markets. Transactions are going to fall. We've all seen the news on existing home sales. That's pretty likely. Recent market improvements have been driven by undervaluation. We talked about the equilibrium home price, and that talks to that point. The next cycle is going to prefer mobile and mature buyers. People are going to move for their jobs, and mature buyers are going to leave high-cost states, and that's a great source of market activity. Member services at Real Estate Economics, monthly OR report, sponsorship, opportunities for our webinars, full market real estate consulting services. If you have any questions about today's presentation, call me. I'm John Mulville. You can reach me at 949-502-5151, extension 102. Here's our team. Most all of you know Mark Bowd. He's the principal and founder. Please feel free to contact any of us. This is our sales team again, Judy Duell at realestateeconomics.com, and Sandy Rivera at realestateeconomics.com. Thank you for joining us today. Join us next week for our presentation on Ventura.